Hello, this is Coach Mike with winningstockcoach.com. Going to get started with my weekly market overview video for the trading week ahead. The trading week beginning Pearl Harbor Day, December 7th, 2015. Honestly and ironically, my birthday as well. So hopefully the stock gods grant me a great birthday present with another great trading week. Getting started here, looking at the DJIA chart. That's the Dow Jones Industrial Average. Now, if you look at what we talked about in last week's video compared to just how the weekly candle closed, you'd basically have to kind of stay with the, I'd have to say, the same mentality we went into last week with. Consolidation range, had gotten up into our target point right here for that upswing, consolidating at resistance, and not breaking this projected upper trend line that I discussed in last week's video as kind of that point of playing a breakout with an easy support level or playing the short trade. Now, last week I did talk about as well about how you could take a short trade in this for a little longer term swing on the DIA. And to be honest, I entered that. Now, the weekly chart, the picture it paints is quite literally it closed green for the week, barely higher than what it opened. But that's actually not the picture it painted if you look at the daily chart. As a matter of fact, we had some consolidation. We ran up on Tuesday, gave all of Tuesday's move back on Wednesday. Thursday actually fell out of the 2-week-long consolidation range. And on Friday, right back up into that consolidation range. Now, when you look at that daily chart, it tends to tell you possibly a little bit more than what it should be. Or maybe I should say that our perception may become a little bit more than it should be. You know, we do have a double top up here. We do have the fact that that longer term target projection was already hit. Not only was it hit and it pulled back from, but it hit it again, and again it served as resistance. But now we're sitting here literally with a very, very easy approach, but it's no different than last week's approach. Stay focused on that weekly chart for the DJI. That weekly chart that simply says we're very close to the resistance point, but have not broken it. And as I discussed in last week's video, the only indice that we discuss in this video series that did make a lower low on that weekly chart, which would have us assuming it was going to make a lower high. So a little bit ironic there, but in reality, even though last week showed a bit of volatility, really just on Thursday and then Friday, the week concluded really doing nothing. Now, granted, it did make a slight up move for the week, but it was only slight and it's only still within our consolidation range. So a simple way to look to play this. I want you to remember the value off the daily chart of 17,918 and 15 cents. If we close a day above that, we will definitely be breaking over that trend line and we'll be breaking over a swing high from our daily chart. In that case, any reference to the short trade off the most bearish of the charts that could possibly be at a top point would be invalid. Now moving over to the SPX, that's the S&P 500. Not much different to say than what I said about the Dow Jones chart. This one actually closed more of a doji, large lower wick. A lot of things we could say there. The daily chart has that same resemblance to the DJI chart. Had a 2-week long consolidation, popped up on Tuesday, gave all of Tuesday's move back on Wednesday, fell out of the consolidation range on Thursday, and right back in it on Friday. Now, depending on how you take that, that's basically like nothing happened during the week. That's what the doji candle implies. Now, what I used that dip for is I had some options that expire, various expirations throughout December. I exited those on Thursday, had some short-term trades. Those members of the coaches roster that were with us in the chat room all week, we had some fun with it. But I actually did not exit my put options for January, even when it popped back up on Friday. I scale into my longer term trades and had only gotten a single buy on them. And I look at this run up into consolidation as maybe another opportunity to add to them. But I did take profits on my December put options on Thursday. In essence, though, when we look at this SPX chart, the doji candle simply tells us we gotta wait. It's an indecision candle. Now let's think about the indecision. It's been discussed that interest rates might rise in December. Then we hear from Fed chair. We heard back in July, and we also heard again this past week that the data says we should start raising them. And actually, if we don't start raising them, we won't be able to raise them slowly, and then it could really put a hurt on things. Could the indecision be simply waiting for that? Now, we did have a good jobs report and some other good information that come out, and you could actually take that different ways. Personally, I think that the good information simply validates the position of the likelihood of a rate increase. The better things seem to be economically, the more likely the Fed is to take action that, in my opinion at least, is actually far past due. As far as the SPX go, we did have, unlike the DJI, that higher low here when we dipped there in late August. We failed at this time so far to make a higher high. In this down trend line projection, that's simply a reference to mimic the DJI, a more valid descending trend line for the DJI than on the SPX, admittedly, because of the pattern we're at. But another point, too, that we can use as the break. Now, last week I discussed that because of the move made and kind of falling short of a projected target, but being into a thick volume profile of resistance, I mean, we did spend 7 months in this range before, simply at this point, letting it break through that and making short-term trades off of this particular index based on that break, but also realizing that, you know, when you look at these candles all closing in the same range, there's no need for you to feel rushed or to feel a need to hurry into these trades on S&P 500 charts, simply because even though you're having some short-term volatility, intraday volatility, maybe even volatility on the daily chart, your weekly chart is staying pretty flat. If you're not going to go anywhere, chill out, save your money, wait for a better opportunity. Again, in last week's video, we talked about the NDX, and my reference to it was actually the most bullish of the indices. We had already gotten a higher high after the higher low, and I talked about it needing to push just a bit to the upside, but I wouldn't even worry about trading the long there. I would worry more about, hey, if we get to that point, what pullback do we get to go long again on what right now is the most bullish of our indices? I also discussed last week using short-term trades only to the downside, using this green line here at 47.0723 as your stop point. Now you could say, well, hey buddy, it just closed above that. But let's really look at what it did for those short-term trades. It held through the week, fell below. It gave you an excellent short-term trade with Wednesday and Thursday. And while it did pop up, you had opportunity to profit on the short term and got a safe exit. I would again actually approach trading on the NASDAQ this upcoming week the exact same way. Plain and simple, use the weekly close point, now at 47.1612, as a resistance / stop to play the downside, the short side, for short-term trades only. And by that, I'm talking mainly day trading. Be in and out in a day, or at least exiting most that same day, taking very little risk to hold to the next day, and simply short-term trade it until the time that we get up into this target area, if we do at all, and get a decent enough pullback to a support level that's more healthy and stable to produce longer-term profits. Finally, now over to the Russell 2000. That's the RUT. It's the small cap index. We actually talked about last week if it were to follow suit with the Qs, or I'm sorry, the NASDAQ 100 and also the S&P 500, that it hadn't really gotten moving yet. So if we saw that break over that projected downtrend channel on the Dow, or continuation furthering from the swing high break before, to look at it for a long trade. Now, from where it opened, we were unable to even close the day Monday above that line. No continuation. Now, I do want you to look here, though, at this dash line I have across here. Those of you that might be technical traders, I want you to really focus on why I'm now saying maybe at this point you need to wait for a break of that dash blue line. Here's why. There'd be plenty of room to still trade to that upwards projected target after it breaks this blue line. But until it breaks this blue line, we could actually see resistance at this blue line, meaning a likelihood to pull back, and a really good setup for probably the most bearish of all technical patterns, the head and shoulders. And we've seen that head and shoulders pattern on many, many charts over the past several months. So as we look at this here, it might actually give you a better probability of producing a winning trade to simply wait for a close above 12.15.21. You might miss out on a little bit. You're not going to miss out on a lot. And that little bit of time, little bit of value you miss on would actually strengthen the probability of you to produce a winning trade if you can be patient enough to wait for that to break. The final thing I want to discuss is I've actually brought up the 15-minute chart, an intraday chart for the S&P 500. Now, in our chat room, I am always discussing swing points as a use with the S&P 500. And we watch the SPY for intraday trading because it gives us a better sense of volume as well being put on the chart. And it's also something we can trade the options on fairly easily. But we talk about the swing points and the need for it to retest swing points for it to have strength in a move. We've even seen many, many times that we've studied in the past that when it fails to retest a swing point, you actually can many times get some weird, crazy looking run that right when it makes you think this thing's going to go up forever, it stops going up. Now, if you look at the swing point I've marked here, the value on that is 2094.92. If you look at this last fall when it started falling through Wednesday and into Thursday, if I put a line right here and I mark the move, you see I would have had a swing low point right here as well. It had failed that swing point, actually broke just a tad bit above it. And here on this up move produced another swing low point. After failing that swing low point, it retested it. The problem was you never got the retest of this one up here. For me and for my approach into the upcoming week, because I am going to remain a little bit short term in my mindset until we get a firm answer from the Fed as to whether they'll raise the rates. I am simply using this line at 20.95, we'll say, as what I'll call my bull bear line. What do I mean by that? Well, what I mean basically is if we begin to pull back from this level, my short-term trades will be heavier in the bearish nature. That doesn't mean I'm a perma bear. I'm not a perma bull either. I'm a market neutral. I'm one that simply wants to react. Now, the other thing I'm going to remain very, very observant on is this swing point I'm adding to my chart right here. Now, I talked about a head and shoulders on a longer term chart with the Russell 2000. I've talked about them with other charts, but we actually have the opposite on the short term chart. This is an inverted head and shoulders, where you have a shoulder here, the head area down here, and a shoulder here, and this was that neckline / breakout line. And we see breakout patterns all the time that will retest the breakout point, and if it holds, can make another move in the breakout's direction. Well, what that does is gives me a little bit of a sense of we could actually get more bullish move, and that's fine. I don't mind a bullish move, but we'd need to break over 20.95 before I'd try to trade beyond 20.95. And any pullback from this area would have me bearish in the short term down to this 20.78 area. It's a very, very simple trade plan approach, but it's one supported by strength of a technical pattern and a support level at this point, right here at this 20.7806. Now, should that 20.7806 fail, I will have no problem adding to my January and even further out swing trades for the short. If the 20.95 is broken above, before I would exit my longer term trades that may be short at this time, I would actually refer back to that trend line we have on the weekly chart, which actually gives a little bit more upside into the 2100, 2110 level. But beyond that point, I would simply react. And my reaction would be, if it breaks above my resistance, I need to stop out of shorts. If it breaks a resistance, I need to prepare for a momentum trade in the long direction. Very, very simple, based on reaction and not thought. See, a lot of times, thought actually causes us to do the wrong things. Thought driven by greed. And that's not what we really want to see. So a really simple approach for you guys here. Resistance point, 20.95. Support point, 20.78. We come out of the gates on Monday and start to look down or up. The last time I checked, the futures were down, but a minuscule amount. And simply play in the short term based off of those resistance and support points. And with an unbiased process of thought, simply a plan to react. This is Coach Mike from winningstockcoach.com, wishing you the best of luck in the upcoming trading week. Check us out, the Coach's Roster newsletter, or even subscribe to my free newsletter, The Practice Squad. Good luck and God bless.